Welcome back, everybody. If you're like me and you listen to any amount of financial news, there's one word that you're probably so tired of hearing at this point that you just can't stand it. And that word is...
a recession.
Recession.
A recession.
Recession is coming.
Every day we're talking about if a recession is coming, if we're already in a recession, if not being in a recession now means the actual recession will be longer than a normal recession, if the final episode of Recession was good enough, or if recession was actually the second gunman on the grassy knoll. Okay, so you get the picture, but other than being a way to increase panic and scare people and get clicks, why do so many people actually care if we're in a recession or not? In this video, we're going to dig into that question, as well as try to understand what a recession would mean for our stocks and investment portfolios, and what we should actually be doing about it, if anything. But first, if you're anything like me, the initial thing you're probably thinking is, what exactly is a recession anyway? So a recession is a period of temporary economic decline during which trade and industrial activity are reduced, generally identified by a fall in GDP in 2 successive quarters. Now, this is what most people think that a recession is and what the definition says, but as we're going to find out, it's a little bit more complicated than that. The point is that our economy moves up and down in cycles, and this Wall Street Journal video had a nice visual that kind of shows how it works.
Business cycles are patterns of peaks or high points and troughs, low points in economic activity. That period between a peak and a trough is a recession.
And to me, this is really helpful to understand the visual representation of what a recession is. Because I think we can all agree that 2021 was definitely this high point right here, and we've definitely been coming down from that. But the question is, if we're not technically in a recession yet, does that mean that we have a lot more down to go, or when would we actually hit the bottom? Now, believe it or not, the definition of recession is a little misleading because it says that they are defined by a fall in GDP in 2 successive quarters. But actually, determining whether or not we're in a recession is more complicated than that, because it's not determined by any specific piece of data. It's determined by these 8 people. So who are they? They are the National Bureau of Economic Research's Business Cycle Dating Committee. And in case I'm not the only one, business cycle dating kind of sounds like...
You're in my seat? But I'm doing you a favor, believe me.
Okay, I'm kind of reaching on that one, but this group looks at data related to income, employment, spending, and production to try to determine if we're officially in a recession or not. And at the same time, everyone else is trying to figure out what they're seeing, what they might be thinking, and that makes it tough for investors like ourselves to try to process all these different viewpoints. Because you have the Fed saying things like this.
It has been my view consistently that we do have a shot, and my base case is that we will be able to achieve inflation moving back down to our target without the kind of really significant downturn that results in high levels of job losses that we've seen in some past instances, many past instances of tightening that look like ours. That's been my view. That's still my view. So the staff now has a noticeable slowdown in growth starting later this year in the forecast. But given the resilience of the economy recently, they are no longer forecasting a recession.
And now this is back from July, but even back then, they were already at a point to where they weren't forecasting a recession. And they got to September, they paused rate hikes, and they just kind of want to see how it goes. But you contrast that type of view with ones like this.
So what's next is earnings season. And as opposed to the last year or so, expectations are higher. They're more optimistic. So now you've got to actually bridge that optimism with reality. I personally think there's a chance it falls short. Look, I think the market, I've been cautious in the market for a number of weeks, remain very cautious on it. I've trimmed exposure. Here's the issue. I do believe we go into recession. I don't believe there'll be a soft landing.
And I think this is an interesting point because he's basically saying, look, earnings season is coming back up. The economic data has been lagging if the effects haven't been felt yet. And so what you may get is a market that's optimistic because there's been a run up in 2023 now with earnings that are going to probably disappoint. And he thinks there's going to be a recession. But then to top it all off, you have news like this.
Taylor, just got JP Morgan's weekly economic report, and they are calling off their recession forecast for this year. They are crediting the quicker than expected resolution of the debt ceiling, as well as less impact from bank credit tightening as a result of the Fed's program put in place. Now, they are saying recession risk is still elevated for next year.
Taking it off the table for this year, but they say the risk is elevated for next year. Is there any color as to why?
Yeah.
Or is it really just the effect of rising interest rates?
I think it's the effect of rising interest rate, but they also signal out the idea of the Fed over-tightening relative to the economy and the inflation problem.
All right.
So on one hand, you have people saying, no, we don't think it's going to happen anymore. And then on the other hand, you have people saying, oh, no, we definitely think it's going to happen. And then you have a third group saying, well, we don't think it's going to happen right now, but there's a higher risk that's going to happen later. So if you watch these clips and you're just like, what am I supposed to do with this information? You're definitely not alone, because I think this is one of the biggest challenges for us as retail investors, just trying to sift through all this different information and figure out what we're supposed to do about any of it. What is it about recessions that we're just inundated with countless articles, interviews, and warnings about being in one? Well, the short answer is obvious, because in recessions, people tend to lose money. Because not only do recessions signal a slowing of the economy, which can mean loss of jobs or reductions in salary, but it also means that stocks usually go down. But the issue is that, just like with markets, these things seem obvious in hindsight, but when you're going through it, it's not all that clear. And as a matter of fact, the NBER usually doesn't even confirm that we're in a recession until months or even years afterwards. Wait, what? Yep, you heard that correctly. So let's dig into the last 3 recessions, and I'll show you what I mean. So the last one was in 2020 during the global pandemic. Officially, we were in a recession from February 2020 to April 2020. The S&P was at about 3,300, and it dropped approximately 34% from peak to trough. The NBER confirmed the recession and announced in June of 2020. Now, by that time, it had already been back on the upswing and only 5% off from its pre-recession top. And about 2 months later, in August of 2020, it hit those pre-recession highs again. And that one was a little bit strange because it was such a short recession and quick recovery time, which was actually the shortest out of all the ones on the list from 1955. But now what if we go back to the great financial crisis in 2008? Officially, we were in a recession from December 2007 to June 2009. The S&P was at 1,500 and dropped 56% from peak to trough. The NBER confirmed the recession and announced on December 2008, a full year after it had started. And at that point, the S&P had already gone down 41% to 876, but it did continue to go down another 16% before heading back up. In January 2013, the S&P hit 1,500 again, 6 years after the recession started and 5 years after it was announced by the NBER. So obviously the impact of that recession was felt a lot longer. And even though stocks did start to come out before the recession ended, it didn't hit those pre-recession highs for another handful of years. Let's look at one more example to see how it compares, specifically the 2001 tech bubble. Officially, we were in a recession from March 2001 to November 2001. The S&P was at 1150 and dropped 49% from peak to trough. The NBER confirmed the recession and announced on July 17, 2003, over 2 years after it started and about a year and a half after it technically ended. At that point, the S&P was already on its way back up and just down 14% from its pre-recession high. In March 2004, it hit 1150 again, 3 years after the recession started and about 8 months after it was announced. So what does any of this actually tell us? Well, here's my main 3 takeaways. 1, by the time that we get confirmation on a recession, it might already be over. And then 2, in general, stocks bottom out and start their uptrend well before the recession is over. And then 3, recovery times can vary by quite a lot. So all that being said, what should we actually do about it? Now, I know I'm going to sound like a broken record, especially if you've watched some of my other videos, but the answer is probably not much. Now, a caveat to that is if you're in retirement or planning to retire over the next 5 years, you might want to look at capital preservation or income plays just because we don't know if there's a significant drop still to come, and if you're close to retirement, that could be a problem. And now, in general, good portfolio allocation advice is that you should be less in equities and more in fixed income as you get closer to retirement. And with treasuries at 5%, they're extremely attractive if you want good yields without the market risk. So they make a lot of sense for income investors right now, but obviously weigh that against your own personal goals and investing strategy. But if you're not in retirement or close, and you're an investor with a long-term time horizon of 10, 20, or 30 years, then you probably don't change too much. As one, we have no idea when they're going to announce a recession or if and when they actually do. 2, we don't know how long a recession is actually going to last because the last 3 lasted 2 months, 18 months, and 8 months respectively. And then 3, the amount of time it took to recover from the pre-recession peak varied greatly as well, where it took 7 months in 2020, 6 years in 2007, and about 2 years in 2001. So with that many unknowns and variability, you're just going to drive yourself crazy trying to time it up all perfectly. The best course of action, in my opinion, is to keep focused on finding high quality companies and building your positions in them as they hopefully trade for more attractive prices. And be prepared to hold them during significant downturns in the market as these recession fears either come to fruition or not. Because we can just drive ourselves crazy trying to listen to all these opinions and predict these things that are really outside of our control. Now, unless you're the type of person that wants to get in and out of positions a lot based on macro factors, it's probably best to just keep working your plan and try to take advantage of great companies that hopefully go on sale. And just like I mentioned in the video about the Fed pausing rate hikes, the game plan is simple. 1, secure and grow your income. 2, find great companies to buy, hopefully on sale. And then 3, be prepared to hold for a long time. But as you guys know, the hard part isn't coming up with the plan. That's the easy part. The hard part is actually executing the plan, staying disciplined, and not getting distracted by every crazy headline or scary price chart that we see. Because we might eventually go into a recession, and we might not. We might actually already be in one and not know it, and we may not even have it confirmed for another year, at which point it could already be over. I mean, do you see how ridiculous these conversations get? It's madness trying to keep up with it all, and even more so if you're trying to make quality decisions with information like that. So what do you guys think? Are you worried about all the recession talk? Let me know down in the comments below. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you guys in the next one. Peace.